and welcome to the Fundamental Value podcast, hosted by Joshua Frank, co-founder and CEO of The Tie. On Fundamental Value, we speak with leading analysts, traditional finance and digital asset firms, and investigate how leading minds in the cryptocurrency space research, analyze, and quantify the value of digital assets. Quick disclaimer, this podcast was recorded and is being made available solely for informational purposes.
Today, I'm excited to be joined by Thomas Chen, Managing Director and Global Head of Sales at BitGo. Thomas, it's great to have you on.
It's great to be here, Josh. Thanks for having me.
So, we always like to start with the question of what did you do before crypto, before finding this industry?
Yeah, I could also tell you a little bit about how I got red pilled. So, went to school in Virginia. I always thought I wanted to be in banking because all my peers were in banking, right? Seemed like the natural thing to do. And then I had a brief stint in one summer trying to do some sales and trading and realized very quickly that was not the path that I wanted to go. So pivoted pretty hard and went into tech, especially fintech on the sales side across in Virginia as well as Silicon Valley. So for a long time, for about 8 years, I was in Silicon Valley doing enterprise sales. And then 2017, the bull market came and then the bear market started in 2018. At that time, I started thinking to myself, did I want to go to school? Did I want to go to a different industry? And because a lot of my friends were already in crypto, I started looking at crypto as a very interesting opportunity and thought to myself, well, why don't I make this my MBA, right? Why don't I give myself 2 years? That's my thesis. And if it works out, great. If not, I still would have learned a ton. So I'll stop there. That's the quick story about how I ended up at BitGo.
And when did you start at 28? So you basically, I guess Bitcoin's up because you started after the 2017 spell, but it's pretty funny that, Bitcoin has done a little bit of this since, since you first started, right? In terms of,
Yeah. This is not the first winter I've been in, right? This is the second winter. I purposely joined BitGo, or rather entered in crypto during the winter because I knew it was a time to build. So certainly myself, nor the company are phased by this. The company has been around since 2013. Definitely not his first rodeo, definitely not our CEO's first rodeo when it comes to crypto winters. And ever since 2013, all we've done is kept our head down and continued to build, and it's yielded a lot of results.
So why join BitGo, right? BitGo now does a lot, but at the time it was just a custodian, which, on the surface may not seem like the most exciting place for somebody to join. What drove you to the firm? Yeah,
of course. So if you really think about it, if you rewind the tape to 2018, you were around back then too, similar vintage as you, as I. There were still a lot of not fully legitimate or kind of called somewhat scammy. We were kind of in a wild west, right, of crypto. Even
somewhat is a very generous term.
Right, exactly. So when I was examining the space, I thought to myself, well, what is my background? What is my edge? And what is my entry point? At the time, I was doing enterprise sales with a focus on fintech, right? So hedge funds, private equity, VCs, corp dev, etc. Those were my clients. And I figured that would be my entryway in. From there, I started listening to a lot of podcasts. One stuck out, which was Laura Shin's podcast. And there was one particular one that said, how to get institutions into crypto. Even in 2018, everyone was saying, we have to solve custody, we have to solve custody, we have to solve custody. And in one of the episodes, I can't remember who the panelists were, but all of them cited this company called BitGo. Of course, being new to the space, have never heard of the company, did some research, reached out, and was lucky enough to get an interview and then help start the New York office.
And so, BitGo was one of the earliest custodians to crypto. And so, obviously you were not, there on day one at BitGo, but you have been at the firm for 4+ years. What did the client base look like when the firm first started? Because they weren't really, I don't think they were serving institutions at that time. There weren't really any institutions when BitGo first got it started. So I'm curious as to what the client base made up of. And BitGo's service is a lot more than just institutions. So curious, as to who BitGo's services and how that's changed and evolved over time.
Of course. So BitGo started in 2013. And the evolution of BitGo is very fascinating because it mimics the evolution of the crypto infrastructure ecosystem. So let me explain what I mean by that. So from 2013 to 2017, BitGo was almost predominantly a SaaS-based hot wallet, programmable wallet, right? We're the first multi-sig, multi-chain wallet for Bitcoin and some other chains like ETH, Dash, right, etc. That was the main business line for the first 4 years. We were the developer-friendly, developer-first API product, and a lot of our clients today were started off very small back then, right? Like a Bitstamp. In 2017, after the bull run, if you remember, we were seeing there were news and headlines of hacks from exchanges every single month, right? So March goes by, all right, they got hacked. April comes around, who's next? And got to a point where there was a need for custody, but not just custody in the sense where the keys are held offline, but a regulated, qualified custodian from a legal framework perspective. So we set out and we actually came out in 2018 with the first regulated, qualified custody product out of BitGo Trust in South Dakota, and it had an insurance wrapper around it. That was when our brand still kind of slowly became synonymous with custody. From 2018 to 2020, that was the bulk of the business as we continue to ramp up qualified custody. Remember, we're also in a bear market. From there, after we've laid the foundations, the security foundations with the tech, in the middle, if you view it, the next layer up is this qualified custody regular layer. We started layering on more interesting features. So things today that we have: trading, borrowing and lending, loan servicing, prime-like services for institutions. We also have things like DeFi wallets, staking, and even NFTs. So really, we start off small with wallets serving a community that was developer first, slowly iterated on that with security in mind, security in our DNA, and kind of grown into this very large product set. I think we have like 12 or 13 different product lines under this BitGo brand umbrella.
And so something funny you said was Dash, supporting Dash. So I'm wondering, what random chains does BitGo support, if there's any other than Dash, that just, look, it's been almost 10 years for the firm, right? And so, naturally, usually on a monthly basis, what's interesting in crypto changes and revolves and dies and something else comes out. But over 9 years, crypto's had a lot of evolution. So I'm curious, are there any other chains that you guys support that are just like, do you guys support like Purecoin or like any or Feathercoin or any random things like that?
So we support about 25 L1s today and over 500 tokens, the majority of which are ERC20 tokens. We also support tokens based on Stellar, Hedera, and Solana very soon, right? The reason why we support this many coins is, unlike some of the other players in the space that are purely custody or purely programmable wallets, we span both. So tangibly, what this means is we have Pantera as a client, but we also have Bitstamp as a client. And Bitstamp, because they have retail users, guess what retail wants? Therefore, we have to be able to we need a factory to be able to build support for all these coins. You call them random, but at a certain time and place long ago, they were probably the hot coin.
No, I mean, what I was trying to get at was now random, was not and is now. So is there anything else are there any other L1s or chains, not ERC20s? I'm sure you guys support a number of ERC20s that are totally dead at this point. But I'm curious, just like, are there any L1s where you guys went through? I mean, it takes a lot of work, and I'd love to get into that later, to actually support a layer one from even, we're a data company, right? So even to like run nodes and infrastructure to support L1s from a data perspective is difficult. I have to imagine custody is even more difficult. So, when you go out and you support something like Dash, I mean, that's got to be a significant investment. And so at that point in time, it obviously was big. So
yeah, it absolutely is. So some of the other L1s that call it not as popular, or definitely not in the top 25 today, think EOS, think Tezos, right? At the time, there's a lot of potential. There's a lot of interest from the crypto native community.
Is that generally, so who's driving it, right? So obviously the token issuer can approach you, but is a lot of what drives the listing of new L1s, is the institutions themselves demanding these assets? Is it the retail exchanges? Like, what gets you to say, oh my God, we need to support this thing?
Yep. It's a fantastic question. And to answer that, let me lay out the value chain, right? The way that we see the value chain is essentially at the very start, you have VCs. That is where the capital is. They decide which projects to invest in. Let's just use Miston, for example, since it's very popular at the moment. Okay, so then next down the value chain is Miston. There's a lot of hype around Miston. They do a good job of marketing, etc. And then all of a sudden, ourselves and exchanges and everyone else almost have to put on like our VC hat, and even yourselves, right? And start to think, okay, well, what are the trade-offs? Should we support a Miston or should we support an Aptos, right? Because we have very limited bandwidth in terms of scarcity of resources and engineering resources particularly. So we almost have to put on our hats and really think, what is the trade-off, economic trade-off, selecting one versus the other? In a lot of these partnership agreements, there's a commercial piece involved as well. And then, of course, downstream, the uniqueness of BitGo is, look, when we support an asset, we have about 700 institutional clients, 155 of them are exchanges. We'll probably support close to a third of all the exchanges in the world for crypto, right? They're actually sitting on BitGo rails. So the moment we turn on support for one of these L1s, Bitstamp and its peers can activate and list that asset. So it's an incredibly powerful network that we have. So we have to be very, we have to be very precise as much as possible on which coin we support, but we don't always get it right for macro conditions or otherwise.
Well, yeah, I mean, I think that's really interesting, right? Because a lot of new L1s come out, they raise a ton of money, and they could probably be like, here, guys, here's a ton of money to support our chain, right? But you also have that other side of the equation, which is like, do the institutions care? And that's actually something that we struggle with as well, right? Is kind of weighing that, yeah, we could probably generate some revenue from this chain paying us, but is anybody actually going to care on the other end? And, seeing
absolutely. As someone that runs the revenue for function for BitGo, it's, oh my gosh, that amount looks great, right? But is that just a one-time thing? Because downstream, the institutions are not interested. And you have to think about the maintenance cost as well. After we support a chain, it's not like it's done. There's ongoing maintenance when they update their nodes, update their chain, etc. If there's a fork, right, there's a lot of work that goes into maintaining it as well.
And so what chains are you guys hearing, a lot of demand and buzz from? I think you mentioned Miston, but what else is kind of like what's on your radar is maybe we're not going to support it yet, but things that you're following?
That's a tricky question. So let me take a step back and answer that from the frame of our customers. We have three types of customers. One, our platform clients. Think retail aggregators, platforms, the Bitstamps, the BlockFis, right? They will come and build on top of our API tech stack. They usually serve retail. So from their perspective, they really just want whatever retail wants, right? We had a huge,
you need all these new doggo chains, Thomas.
That's what I'm saying. With the amount of kind of inquiry on supporting Doge, which we today do not support, it's on the roadmap, right? Was tremendous back when they were the darling during the Robinhood GME era, right? Even Cardano today, right? We still get a lot of pressure to support Cardano, but there's not institutional interest in Cardano or Doge. The second client type are the institutions. So these institutions, they kind of, from a spectrum, they are as crypto forward as VCs who are interested in chains, of course, that they've invested in that are probably proof of stake that they can then park at a qualified custodian like BitGo, so you get all the protections and you get a sweet yield off of that, right? All the way down to your RIAs, kind of slow moving, but hey, I just want to allocate 2% to Bitcoin ETH. They don't really care about the hot stuff. And then very to wrap things up, the third segment that we have are these L1s, and that's when that competing priorities, those discussions come into play.
And when you go and you support these L1s, will they then go custody a percentage of their assets with you guys?
Depending on the deal, but naturally, it's kind of a no-brainer for us to be the first to support it, for them to custody, for them to stake. That's all baked into the arrangement.
So something that you mentioned a bit earlier is having 700 institutional clients. And obviously, I think you bucketed a lot of stuff in that. So would love if you could kind of break that out, and specifically talking about funds, like from both a hedge fund and a VC perspective. How big of a client base is that? But I'm also curious, how do you think about the TAM, right? And I'm sure this is a question you've thought about a hell of a lot, just like I have, and how that's growing and how that's changing and how big it actually is. Because, we see folks, come out and say, I think Falcon X as an example says they have like 1,500 institutional, but I never know what that means. Like it's everyone's definition is always different. So I'm curious as to what you think that, what you think that number actually is.
I don't know the split off the top of my head, but I will say that we have an equal number. The way that our sales team is divided is because a platform client versus an institutional client, they speak different languages. They have different selling cycles. Therefore, we have to match them with the similar sales coverage that they're used to. It's equal, it's even, 1-for-1 for us, for both platform and institutions. And that's how we've covered them. In terms of TAM is such a hard thing to figure out, and even more so in crypto because it's so nascent, right? It's not like we're looking at TAM of regional banks, right, which is kind of pretty well defined. Crypto has given, anyone the ability to spin up a project out of their dorm room and capture millions, if not billions, of TVL over a week, right? So it's really hard to measure TAM from that respect. But I would say from the TAM of maybe viewed from like using that innings analogy.
Well, I mean, I imagine with platforms, it's a little bit easier to define the TAM. In that, like, there's only a certain number of platforms that actually have, or that present an interesting opportunity at this point, right? Like, versus with projects, they're always spinning up, and with funds, they're always spinning up, and traditional institutions are constantly adding support for crypto, right? So I think that's probably, but I presume that platforms would be an easier to quantify TAM, because you said it yourself, you support a third, right? So you kind of know innately what it is.
Yeah. So I would say, I don't have a number for you, Josh, but I will say from our point of view, from the exchanges, they are consolidating.
Yeah.
Right. Just like in traditional space, you don't need 100 plus exchanges. What will end up happening from our perspective is you'll have a lot of these major ones in different regions, and then the smaller ones are essentially acting as liquidity resellers, right? Brokers to the larger ones, but they specialize in one specific country in South America, for example. So we see consolidation there. At the end of the day, it's all about network effects. And as a lot of these companies are migrating from Web 2 to Web 3, you see Facebook rebranding as Meta, Square rebranding as Block, right? GameStop coming out with its own browser wallet. I think the opportunity is how can we tap into those existing players that have large demographic and enable them to use certain crypto native functionality that we have versus them reinventing the wheel. That's the opportunity at hand.
And so, as more of these traditional institutions, we were talking about one example before we got on, and so not going to call out any names here, but as more of these traditional institutions come into crypto, what are the major challenges that you see them having? Obviously, custody, you mentioned earlier, was one in 2018. Does that continue to be a challenge? And I'm curious as to what the other challenges that you see are, right? Whether those are prime service related, or it could be anything. It could be fund administration, right? Like, I'm curious as to when you talk to these folks and they're coming into crypto, what are the types of services and things that they need?
The challenge depends on their archetype as a client. What I mean by that is there are certain technical challenge, right? Which is just overall market efficiency and making sure that there's the working capital is efficient whenever you're moving it across different venues and trying to execute whatever your business model is. I would say, let's think about the type of institution. It really depends on who the stakeholders are.
Let's take a hedge fund. Let's take a top 100 hedge fund to simplify.
Sure. Okay. So if you're talking about a TradFi hedge fund,
yes,
then the challenges are still going to be very much compliance and regulatory related. You can design the most elegant technical solution. And then there's also challenges in making sure risk ops, IT, right? Making sure that the crypto infrastructure provider satisfies the high standard of care that they have for these hedge funds. And then you can design the most beautiful, elegant thing only for compliance and legal to come in and say, can't really work that way. So I would say compliance and legal is still very much the tough nut to crack, pending regulation and SEC.
And so how do you go about solving, how do you get compliance teams comfortable with BitGo?
It's a challenge. We've already, a lot of it is being a qualified custodian checks a lot of the boxes already, right? So that they know they're dealing with.
Is there a difference? You mentioned getting it in South Dakota. Is there a distinction between individual states, or is there a national qualified versus state level qualified custodian? It's
a great question. So let's take a step back. When we say qualified custody, that's defined in the Investment Advisors Act of 1940. Now, that basically says, hey, if you are an RIA, if you are regulated in the US, you have to use a qualified custodian to hold user assets. Now, the SEC, the governing bodies have now come out and said, oh, in crypto, this is how it applies, right? So in lieu of that, a lot of us, the major players, our peers, and ourselves, have said, okay, well, let's just become a qualified custodian. The fact that we're in South Dakota doesn't really matter. Just like how Delaware is the friendliest state to LLCs, South Dakota is the friendliest, right? And there's reciprocity amongst pretty much all the states except New York. So we also have a New York trust.
Makes sense. That makes sense. And so, what are, besides for the qualified custody piece, what are the other types of concerns that folks have around custody within crypto? I'm sure technology, security. I'm curious, like key management, like that's a big deal, right? So how people even think about, wallet and key management and permissioning and things like that.
Yeah, it ultimately, the security at the end of the day is probably the most important, because if you, as you well know, in crypto, these are bearer instruments. So if you lose your keys, you lose access to the wallet, and the funds are gone, irrecoverable, and you're running headline risk, right? Nobody wants that. The way that we do it is we pioneered, so we didn't invent multi-sig. This is like a decades old cryptographic proof that's been battle tested over time. We were simply the first ones to pioneer it for the Bitcoin blockchain and therefore other chains that support it natively. So from a multi-signature perspective, the way that it works is there are 3 keys, and for cold qualified custody, all 3 keys are held by BitGo Trust, a regulated entity within the US, and it has insurance. So we abstract away the complexity and the burden or the risk of you holding the client holding the keys, and BitGo Trust maintains all of it. I'm happy to get a little bit more detail about the actual technical details if you like.
Yeah, and go into it. I think it's interesting.
Sure. So the way that it works is there are 3 keys, right? You can think of it as the user key, the BitGo key, and the backup key. In a cold wallet scenario, the user key is sharded using Shamir secret sharing into a number of shards. I don't actually know how many, right? For risk reasons, let's just say there are 8 shards. And those 8 shards are then managed in bunkers that are underground, geographically distributed in the US, right, from BitGo's perspective. And we have different teams that are going into these bunkers. The folks who have access to these bunkers, which are, they have 24/7 security, security cameras, biometric scanners. The folks who have access to these bunkers, these safes, are different than the folks who have access to the key shards. And so when you want to sign a transaction, there's a whole orchestrated movement, manual movement of people in these safes going in, signing these transactions, reconstituting the key using the shards, signing it with the BitGo key, which resides in a hardware security module. It's a tamper-proof device in a Faraday cage, in order to bring that transaction online.
And so how long does it take to move from cold storage then?
So the funny thing is, it's really a function of staffing, right? In our SLAs, contractually, we say 24 hours, but we're actually clocking like 3 hours after the video call.
Got it. And then for an exchange that you're working with, I guess it's the same. Like, how are you settling at the end of the day? Is most of the funds in a hot wallet and then you'll settle at the end of the day in a cold wallet? Like, how does it actually work? Or is it?
Sure.
Yeah.
So when you say settle, the way that exchanges leverage BitGo is, hey, we'll keep 95% of our assets in cold wallets because they don't move and there's not a lot of withdrawals.
And then for settlement, that's real time with their hot wallet.
Exactly. Well, if people are trading on the exchange, there's no actual settlement. Like when I'm trading on my favorite retail exchange, that's just a ledger update, debiting and crediting my address versus my balance.
Right. But then when the user pulls off, isn't that settlement effectively? When the user pulls assets out?
Correct. So that's why they want to maintain a balance in the hot wallet to facilitate that movement. Yes.
Right. Makes sense. And so, one of the things you mentioned is BitGo is a lot more than just custody. I know I've asked a lot of questions about custody, but BitGo has trading and staking and lending and all these other things. So I'm curious as to where you're seeing the most demand now outside of custody, and if it's surprising at all to you where that demand is coming from.
It is. So given what's been happening in the macro environment and also the crypto winter, we've seen a little less interest on some of the DeFi wallet type products. We've actually seen a boon in interest in NFTs. We've launched support for NFTs in June. And initially, it's to go after institutions who are holding these blue chip collections, right? We support ERC 721, 1155, and also CryptoPunks. What we didn't anticipate
And you can theoretically support any ERC 721. Like, it doesn't matter what the smart contract is.
Right.
Got it. Okay.
What we didn't actually expect was we started getting a lot of inbound interest from global Fortune 200 brands, the largest media brands that you can think of.
Right, like Adidas wants to custody their. I'm not saying they're a client.
Yeah, as an example,
Adidas,
yes.
Yeah, would want to custody their NFTs. That's interesting. Yes. It makes sense. I mean, it makes sense.
It does, but with the NFTs, there's a whole other concern. Not so much regulatory and compliance, right? They have to think about KYT, KYC. God forbid a Disney, right, sells an NFT to North Korea. You know what I mean? So there's a lot of other minutiae and details there that we have to iron out. And those are just examples. But it is very fascinating that that's probably the area of interest that we've seen spike up.
What? I mean, if you're not comfortable with answering this, don't. But I'm curious as to like what percentage of new assets under custody is NFTs? Like, is it like more than 10%? Like, is it?
No. So short answer is no.
Okay. But it's still a large amount. It's still just a surprisingly large amount.
The interest is there, yes.
Right. Okay.
And
got
then
it.
you start to have to ask yourself, how do you value an NFT?
Right.
Is it based on the last price sold? Is it based on the floor price? It starts getting tricky. There's no standard for that in the industry yet. So that's a whole other thing that we're
yeah. So how do you even mark to market to charge a custody fee if it's a fee-based, percentage-based model on an NFT? Like, how do you even define, like, okay, I know how to charge 20 basis points. I don't know what BitGo's fee model is, but as an example, I know how to charge 20 basis points on Bitcoin custody. Super simple. And you could probably figure it out with CryptoPunks or for Bored Ape Yacht Clubs. These assets are relatively liquid. I think there's I think the floor price is pretty generally accepted. You could probably take that as the value worst case. But I'm curious, like, as you start getting to like NFT number 272, how do you even, I mean, I'm curious as to how you guys have thought about that.
Well, the other challenge there, Josh, is these are illiquid assets, right? So if you somehow stumble upon the next Bored Ape and it moons, all of a sudden in a traditional custody model that you mentioned, you're going to be hit with a very large bill. And then let's say it tanks because people are pumping and dumping. That's not very fun for you and your management fees, right? So at the moment, right now, we are not charging explicitly for funds for NFTs. That may change, but the goal is, look, right now, if you're not using BitGo, then it's a challenge, right? You run the risk of getting hacked and the assets stolen, but we're pricing in conjunction with the entirety of their AUC or AUM.
Right. Got it. Yeah. I mean, I don't know I wonder what it's impossible to know what the aggregate market cap of NFTs is, I think, because it's just impossible to know, to our point earlier, as to what these things are actually worth. And, the second people start selling them, right? I mean, that total market cap probably looks a lot smaller than what it looks like on paper. So that's actually super interesting. And I want to talk about lending now. So, we've obviously seen, I'm not going to call out particular names other than Celsius, because I think they're the ones that deserve to get called out. But we've seen the collapse of a number of different lenders in the space, or at least struggles, right? Where, there were a large number of folks that were lending to Three Arrows, but there were other really bad loans that were out there too, beyond just Three Arrows. A lot of these lending businesses have either gone under, are now struggling, or many of them have actually just stopped lending or just started to charge really, high collateral requirements on their loans. So I'm curious, how has any of that impacted BitGo's lending business?
Yeah, so our lending business has always been pretty stringent when it comes to risk management and collateral controls, right? Unlike some of our peers, we are still standing with a pretty strong loan book. We did not take on some of the other, call it, counterparties that demanded under collateralized loans or uncollateralized loans, simply put. So because of what's happening now, we actually see a vacuum in the space, and there is opportunity to fill it. I would say even as recent as July 4th, not much happening, not a lot of cash flowing around. But now there's a lot of demand, and a lot of people looking to lend BTC and get yield. So the market's starting to come back, and we're actually starting to see a lot more counterparties that are okay with one-to-one or slightly over-collateralized loans.
I'm curious what, prime brokerage encompasses a lot, right? It encompasses more than just trading. It encompasses more than just lending and more than just custody. It encompasses things like cap intro and other services that are offered, right? And so I'm curious as to what you think is remaining in that stack for crypto, which really hasn't been built out yet.
The biggest thing is probably around fixing capital efficiency amongst exchanges and
making sure you actually have capital on exchanges to trade on behalf of your
cross
clients.
margin is one that comes up quite a lot. The way that BitGo is trying to solve it is, again, because we are the central plumbing for hundreds of these exchanges, we're actually rolling out an off-exchange settlement product such that, hey, Josh, if you have a fund and you're custodied at BitGo and your favorite top 3 trading venues are also on top of BitGo, you can actually park your assets. It doesn't have to move. You can actually trade on those exchanges. BitGo
That's actually really cool because that solves the issue of you guys needing to have like $50 billion on your balance sheet, which prime brokers. That's cool. I like that. So basically the idea is hopefully that eventually any exchange in BitGo's network, which is a third of the exchanges, you'd be able to park your assets with BitGo and then trade on those exchanges without actually having capital deployed there.
Exactly. And this is really a value proposition for market makers who today, they run the risk of, depending on which exchanges they're on, run the risk of, if the exchange risk of those exchanges halting withdrawals, right? So a lot of them, what they do is they trade or they market make and then they sweep it back into a centralized location and then rinse and repeat.
Well, wouldn't it also make sense for just any fund wanting to make a large trade regardless? Just because,
Of course. But this is also like the cold start problem. We actually rolled this out V1 of this 2 years ago, and unfortunately it didn't take off. Back then, as an exchange, why would you want your liquidity to be free flowing, right? You want to capture it. So a lot of the exchanges weren't as forthcoming or welcoming. I think that has changed with a lot of improvements within the infrastructure. And also a lot of these exchanges are essentially following the Robinhood model where they give away free trades, right? So they have to start to think about, okay, well, how do I get an extended how do I enlarge my liquidity pools? And a lot of them are warming up to this idea of off-exchange settlement.
And I think most exchanges have realized that. And I'm curious. I mean, I think you probably agree because given you talked about consolidation in the space, which I definitely agree with as well. I think there'll be a tremendous amount of consolidation, especially with regional exchanges, right? I think there's going to be a lot of acquisitions, right? Folks that from a regulatory point of view, decide that in Malaysia, I need to have a localized exchange or in South Africa or whatever the country may be. So I think for sure there'll be consolidation. I think, as you probably agree, for sure a lot of these guys are probably going to go under, right? So I think consolidation will naturally happen from people going out of business. But I think, I at least think that exchanges aren't a winner-take-all business. And I think the exchanges at this point probably agree with that as well, right? So they're probably also just more willing and understanding that, yes, a fund is not going to trade 100% of the time with me, but I'd rather get that flow than somebody else.
Exactly.
And so, we talked a lot about traditional institutions coming into crypto. Let's talk about one of the biggest traditional institutions, which is BNY Mellon. So BNY Mellon, which custodies like $20 trillion in assets, is coming into the crypto custody space. And there are others that have, I don't know where they are on that, on the horizon. I think Cowen has thought about prime brokerage for crypto and a number of others at least have publicly talked about it. How does that impact you as a business, BitGo as a business, but how does that impact the crypto market broadly as well?
I would say, look, back in 2019, Fidelity said they were coming in and everyone said, all right, game over, Fidelity's come in and that's the end of it. I think what they and other large traditional finance shops failed to realize was just how difficult it is to build this tech to secure the assets and maintain it and scale it for all the different assets. So I don't think Boney coming in is going to be detrimental. If anything, it brings an air of legitimacy, right? Institutional legitimacy into the space.
I think that's fair. I think that makes sense.
There's another view, by the way, just quickly share.
And also, I can't imagine they're going to be custodying like Dogecoin. So, or NFTs for that matter.
Right. Actually, there was a news article about, State Street Digital and Credit Suisse holding maybe $33 million worth of assets in digital securities. Probably security tokens, right? Like of some apartment somewhere, real estate somewhere, not so much some NFT. There's another view to be expressed around Boni, which is this could be interesting, right? This is with a lot of the regulations that's coming down with this guidance called SAB 121, basically said, hey, if you're keeping assets in your balance, you're custodying it. Or sorry, if you're keeping assets in custody, it has to be in your balance sheet. So if you look at State Street's market cap, and then you look at Bitcoin, and depending on how much Bitcoin they custody, and if Bitcoin 10x's or whatever crypto positions they have 10x, if this is true, all of a sudden they are very outweighed in the risk department when it comes over-indexed, right, on crypto. So what do? Do they sub-custody with somebody else? Do they give it to somebody else? So I think there's still a lot to be figured out from a regulatory standpoint, but we certainly welcome Boni and any other traditional financial institution that's like the pillar of American financial system coming into space and helping us push forward the kind of this new Web3 crypto.
And I think as well, I mean, my perspective on it, one, the person that's going to custody with BNY Mellon is probably not going to be a customer of a crypto custodian anyways. If I have to imagine it's the giant endowments and pensions and guys like that are just going to buy and hold Bitcoin. But I think if BNY Mellon hasn't launched yet, right? So let's wait and let's see if and when it does launch. But I think if it does launch, it also is this really good green light from a regulatory point of view, right? Where somebody like that comes out and says, we are comfortable with the SEC's guidance that we can go and we can do that. Like, I think that in and of itself, even if it never takes off, the fact that they just go and a company of that was founded by Alexander Hamilton, right? Like, comes out and says that we're actually okay. We think that the SEC and US regulators are okay with that. I think that in and of itself, regardless of whether or not it's successful, is just a huge sign for the industry.
Absolutely. And that's probably why, without speculating too much, regulators are kind of hesitant to make any explicit decisions, right? Because once you open the floodgates, a lot can happen.
And so, next I kind of want to pivot and transition to, my favorite topic, which, I'm sure is data. So prior to crypto, you worked at App Annie. And for anyone who doesn't know, App Annie, I've used it before. It's actually a pretty cool product. It shows you a lot of mobile app analytics. And so curious, obviously you're not focused on crypto data as part of your day-to-day, but you've been in the space for 5 years or more, right? So how do you think about data and crypto? What do you think are the most important types of data? What do you think people should be looking at and care about?
It's a very interesting question. Crypto itself probably has more data transparency than anywhere else, right? Just think about the richness of the on-chain data that you can mine. Think about if you're thinking about staking, you can kind of get a sense of how much activity is truly going on a chain. Total value locked, TVL is a metric, right? So from a valuation perspective, there's a lot more transparency. Again, not an expert on this field at all, Josh, but I would say things that are probably going to be interesting are things like TVL. Like, how do we replicate the traditional KPIs, metrics, the PE ratios that are typically scrutinized for public companies? How do those translate over to crypto, right? And the benefit of crypto is that it is auditable.
And so, you're on the Fundamental Value podcast. And so obviously we asked this question to all guests, but how do you think about, I think you kind of alluded to it with PE ratios and stuff like that, but do you think crypto has fundamentals? And how do you think about that? Are there fundamentals in crypto yet? Like, is TVL a fundamental metric?
You're making me, so I majored in finance. It's been a while. The way that I look at it is there will be fundamentals, but it will not be the same fundamentals that we're used to, right? Some things will prevail, like how does a business make money? That will forever be a golden question, and understanding what the revenue model is.
Do any of them make money?
We certainly make money.
Well, I'm saying any of the token businesses, with the exception of exchange. I mean, is there a token out there that makes money and the token holder is entitled to a percentage of that, where there's actually a real business behind it that continues to, accrue value over time?
There should be, but a lot of these token projects end up being Ponzi-nomics, right? I'm a big fan of the research that you guys put out, especially one of the more recent pieces. I think it was Hitchhiker's Guide to Real Yield, right? I think a lot of these projects try to make it such that there is governance tokens or other LP tokens that generate real yield. You can think of them as dividends, right? But what ends up happening is the way that they've designed the tokenomics, it ends up being no better than Ponzinomics. And it's just taking VC money or initial money that's come in, having an inflationary token schedule, and then paying that out in the form of essentially a new way for customer acquisition.
Yeah, I mean, I think it's it's really funny where people talk about yield in crypto, and what they really mean to say is inflation, right? They're like, this token generates this yield, and it's actually no, this token inflates this much, which is kind of funny. And I think something that's interesting is your assets under custody, right? While I'm sure it's grown over time, the makeup of that has probably changed quite drastically because you have a lot of big VCs as clients that have tokens that just moon and then crash. And so, if you probably looked back, and I'm curious, like 12 months ago to where was the largest make, I'm sure Bitcoin and ETH were the largest, right, in terms of the makeup of assets under custody. But as it relates to like ERC20s, it probably looks significantly different.
Yeah, I would say if you normalize it over the course of a year, you get the usual suspects that mimics the top 25 in CoinMarketCap. But yes, you do occasionally get some ERC20s that moon. Again, they're still much smaller than the overall position of Bitcoin.
But you could have like a fund on BitGo that just happens to own like 30% of the supply of a random token that goes up to $1 billion or something like that.
Yep, absolutely.
And so actually kind of a good question that I had. I've been asking this every time. I really love this, which is, you talked about, the top 25 usual suspects. If you look back a year and you normalized it, but I'm curious, like fast forwarding, let's actually go the amount of time you've been at BitGo for 4.5 years. 4.5 years from now, how many of the top 100 tokens by market cap are still in the top 100 by market cap?
Oh man. I would say, again, I don't look at these charts all the time, but I would be willing to bet it's really a question of how many have staying power in the next 4 or 5 years. I would probably say less than 10.
Wow. That's a very hot take. I think I usually ask 2 years, but 10 is a hot take. I don't know how much I do or do not disagree with you. I think it's probably slightly higher than that because I think some things that maybe were top 20 hang on at like 97. So you kind of get that natural skew there. But I think for sure we're going to see that rotation. I mean, you mentioned projects like EOS and you mentioned Tezos earlier, which, Tezos has some activity, unlike EOS, but EOS is still hanging out in the top 100, I believe. If I'm not mistaken, even though it's not the project that was promised, when they went out and actually raised $4 billion.
Yeah, top 100, of course, but from whether or not there's going to be adoption, it probably drops off pretty significantly after 25.
So yeah, I'm curious. So I think that's a good point. Adoption. So there's a big difference between being in the top 100 by market cap and actually being adopted. What is going to cause tokens to be adopted?
If there's real usability.
What is real usability? What defines real usability? And are there any examples of tokens that are actually usable that provide some sort of value to the world?
This is going out of my depth a little bit, but I think governance is a space that there's a lot of opportunity there in what these tokens could represent, what you can do with them, and the value that could accrue to these governance tokens over time.
And so, you've been in the space for a while. What has surprised you most from, about crypto from day one at BitGo to now? What, in terms of how the market has evolved? I think the NFT example with custody is a really good example from a recent business perspective. But I'm curious, just like, can be business related too, and maybe that's the answer, but just broadly, like, has anything surprised you the last 4.5 years in this space?
What's been the most surprising is that there's a high tolerance for failure in Silicon Valley, right? I feel like there's even higher tolerance in crypto, especially when you're playing with very large numbers that are highly volatile, right? The market cycle in crypto seems to be every 1-2 weeks. We hear about a hack. Oh my gosh. Okay. 2 weeks later, you kind of forget about it. I think one great example of this was the Iron Bank when they got compromised and lost hundreds of millions, if not like $1 billion in the value that was in there. And then they relaunched 2 months later and got like 30 to 50% of it back. But the irony of all this is, Josh, once something is compromised or hacked, right, you would assume that it's probably the safest time to be there after they've patched it up. So I guess do with that what you will. But that probably is the most surprising for me.
Yeah, I mean, I think this goes back to what are barriers to entry to institutions coming into the space, traditional institutions, right? I think market related risk is a really important thing, right? And understanding portfolio allocation, portfolio risk, things like that. But crypto also has the unique challenge of smart contract risk. And how many of these projects, like how good is anybody at auditing these smart contracts? Right.
There's a website, right? I think it's called Rekt, REKT, where it literally has a leaderboard of all the projects that have been compromised or hacked, how much was compromised, and whether or not there was an auditor.
Yeah, I mean, and I've actually seen it. I don't remember the exact name. I think Rekt something. It's like Rekt dot something, I think, or whatever.
Yeah.
But it's really interesting. I think REKT, right? But the what else is interesting to me is just like how many of these bridges continue to get hacked and how much money people continue to put in these bridges after these bridges get hacked. When in reality, you could honestly just go to a centralized exchange, and then just basically pull off.
They're the original bridges, Josh. They are the original bridges, but it's full of irony, right? The safest place to bridge something.
BitGo's bridge has never been hacked.
BitGo, we don't have a bridge because we're not technically an exchange.
I was making a joke. The fact that if you went on Bitstamp and you bridged assets, that's all. It was a joke. Maybe it went over. It went over, but it wasn't very seriously. But no, it was. There's no, obviously BitGo doesn't have a bridge, but I mean, it's interesting. Just like like Wormhole got hacked, and then this got hacked, and then that got hacked, and people just.
But I think it also shows like the community is willing to put a lot of capital behind mission critical infrastructure in order to get it right. Right.
It's also high risk, high reward, right, on a lot of this stuff.
Absolutely.
And so, we've talked a lot about, infrastructure and, we talked a little bit about fundamentals and stuff like that. But what in crypto has you most excited right now?
It's actually, you touched on a little bit, not bridges, but how do we go, if we end up in inevitably a polychain world, how do we navigate this polychain system in the most secure way? That's one. The larger picture is, of course, how do we get adoption in all of this? And if you really think about it, at the end of the day, the gateway to all of Web3 is through wallets. So that's why I personally was a big fan of BitGo, right? Because we are a wallet provider where we have a front row seat into everything that goes on in crypto.
And so and this is my final question, what is your hottest take right now? Your most controversial thing?
Controversial take. A lot of my days are just spent working and kind of focused on the business. But if I had a hot take, I would say, I guess frankly, I want to say it's a hot take, but I just don't understand that a lot of these funds that are raising massive fund sizes, how do they ever, return the fund, right? So it feels like the sweet spot could be 30 to 50 million from a VC, right? If you hit the right project and a crypto company returns you in your portfolio at least 5x, right? That's great. If your fund size is 30, 50, but if you've got like 3 to 5 billion, and maybe this is just me not understanding the industry well enough, but I think they have a unique challenge in figuring out how to return the fund, especially in...
Well, I don't even think that's a crypto-specific problem. I mean, take SoftBank, for example, right? They had to throw $100 million or whatever dollars at robot pizza companies. Right. It's just deploying capital at scale is very difficult, right? There's diminishing returns to it. The good thing is, the 2 and 20 model, right? The fact that the first number starts with 2 And so if you got 5 billion in AUM, as long as you're not getting net redemptions, you're probably doing fine. But I agree with you, and I think it's even more critical when you start to look at, because I think there are folks in the space that have done a good job at managing capital at scale. I think where it becomes challenging to me is people that are raising maybe not that level of capital, but a really significant amount in DeFi, because I spoke to one of the largest, figure top 20 hedge funds in the world this morning, and they were thinking about DeFi and DeFi strategies. And what they told me was they think the capacity is really 100, 200 million that one could deploy into DeFi. And they heard of peers trying to deploy 1 billion. And they're like, I have no clue what they're going to do with that money,
right?
And how they could possibly make any money.
Right. Because if you look at the market cap of ETH or the TVLs, it's, oh, God forbid the TVLs were inflated, right? It gets really tricky really quickly. And then, of course, with that amount of money, how do you actually secure it when you're interacting with all these protocols?
Yeah, I mean, the just for perspective, the overall market cap of crypto right now is 948 billion, so it's about $1 trillion. The overall market cap of DeFi is 43 billion, so it's
right.
less than 5%, right? So you're raising $1 billion, right? Assuming that this market cap number is correct, you're trading 2.5% or so of all of DeFi, or 2% or whatever it is of all of DeFi. So it's a pretty big number. Well, Thomas, it was awesome. It was awesome having you on. Always great chatting with you. By the way, for anyone who hasn't met or doesn't know Thomas, he's an amazing guy. And I'm sure if you reach out, he'll take care of you. He's got probably the best network in the entire space. So I have nothing but good things to say. But Thomas, where can the people who want to reach out to you, connect with you and find you in BitGo?
Yeah, absolutely. It's just my email, which is Thomas Chen with no period in the middle, just first name, last name @bitgo.com.
Awesome. Well, Thomas, great having you on.
Of course. Thanks for the time, Josh.